Antipodes Partners, we describe our process as pragmatic value. We're trying to take advantage of markets when they become selectively irrational around stocks or industries that are facing change. On the long side, we're looking for investments that offer us a margin of safety where that return is underwritten by multiple ways of winning. On the short side, we simply invert the philosophy. We're looking for stocks, investments that have no margin of safety, weak companies that are characterized by multiple ways they can lose as investments. And we also see currency as an opportunity to manage risk and also drive returns. As David mentioned, the environment is somewhat characterized by this very low volatility or low share price dispersion. Now, we don't think that necessarily equates with low risk. As Andrew Bowe mentioned in his video address, we see primarily risk as the risk of losing money in a poorly judged investment. But volatility is a measure of something. It's price dispersion. It's very low in the S&P 500 at the index level and also across assets. We think it somewhat reflects the central banks having super easy monetary policy following the global financial crisis. It has pushed investors into long duration exposures. The primary beneficiary, as we know, has been fixed income. But then outside of fixed income in equities, it's been bond-like equities. Now, on the time series that we're showing here, we're basically looking at different style factors, and we've chosen volatility, profitability, and leveraged yield. Profitability is pretty self-explanatory, as is volatility. Leveraged yield is those yields that are underwritten less by cash and more by debt to sustain and to grow them. A lot of what the infrastructure stocks have offered you. Those exposures in markets are pretty expensive. Growth stocks or quality stocks tend to do well when rates are low. So we are just posing the question, what might happen if rates were to normalize? We don't have to have a bear market in fixed income. We could just have a normalization in rates so that they moved back to the longer term relationship to nominal GDP growth. So at a sector level, the big loser in the low rate environment has been banks, especially weaker banks who need an upward sloping yield curve to help them make money. Shorter duration equities like cyclical companies. You take energy. Energy has a lot of cyclical companies in it. Also a very laggard sector. So blue means low valuation versus longer term history, and red is high. So beneficiaries have been consumer staples. Now these consumer staples are no longer super expensive. 12 months ago, it was a two standard deviation type event, and now it's only a 1 standard deviation overvaluation. So there's been a derating. In that group, you can't really see the FANGs, but the biggest outperformers in the last 12 months have been large cap quality tech names. On the other side, you can see infrastructure stocks in North America, over a standard deviation expensive, but not consistently expensive across the world. So we're going to talk about an energy stock. So who am I? It's Australia's largest oil-rich LNG development in 40 years. This is off the coast of Darwin. We've needed to lay this very long pipeline. I know third longest in the Southern Hemisphere is not a big claim, but at first I should say it's the third longest in the world. So this is a very large development. And we describe it at Antipodes as buying back the farm because it's actually owned by a Japanese company. We're investing in Impex, and it owns Ichthys. The reason we think it's cheap, the irrational extrapolation, is simple. Execution risk. But we're now at that point where this project is largely complete. So execution risk is declining exponentially. At the same time, we see multiple ways of winning because it is so close to the start date. We are moving into, in a world that's celebrating growth, we actually have a rare energy company, one that is growing production. And it should be seen more than just a nasty cyclical oil stock. LNG is priced off oil, but we have high quality customers, the Japanese utilities that tend to pay their bills. And we actually see it as a critical part of infrastructure. We've future-proofed the development. So we could expand this by 50% with very low capital cost. So we've opened up the entire Browse Basin, which is an enormous resource. Now, infrastructure assets are generally expensive. INPEX is offering us a 10% free cash flow yield. So we think a very large margin of safety. And it belongs in a cluster that we call cheap energy in the portfolios. And we also see, if you see the valuation metrics on the left there are ways you can hedge the oil price risk by shorting expensive energy. So the shale plays in North America are still being celebrated as growth energy stocks, but they're the opposite to INPEX. They're very short duration. They're on a treadmill. They have to keep drilling because the decline rates, the natural decline rate in their wells runs at around 60%. So moving on to a discussion around high yield, where we see some anomalous, like super tight credit spreads. Junk bond market is very critical to this cycle. The 2007 global financial crisis cycle was more about mortgage lending. We don't see any real distortion in the US or generally, across mortgage markets, but we do see it in the way corporates are funding their capital structure. That US capital structure has never, very rarely been more dependent on the junk bond market. So the lower quality companies in the US are leveraging up. Apple and Google, they don't need credit markets. The shale oil industry is absolutely dependent on credit markets. So Antipodes is an equity manager, so why am I talking about junk bonds? Because there's been lots of equities that have benefited. And I'm going to talk about a cluster that we describe as overhyped growth. And the stock of choice is Tesla. We call it the growth stock for all seasons. Is it the new iPhone? Is it a luxury brand? Is it an alternative energy company? It's probably, to varying degrees, all three. But at its heart, it is a very small auto company with a very large market cap. Tesla, I should say, makes 100,000 cars a year, and it has a $60 billion market cap. We think that's irrational. Where we see multiple ways of winning or losing because it's a short, is simply how competitive electric vehicle industry is today. Tesla represents 3% of current hybrid/electric vehicle market today. It is a very minor player up against very large and competitive companies. All the Japanese, all the Koreans, all the Germans. Toyota is very strong in this area, but so are the Germans and so is Hyundai. It will require an enormous amount of capital for Tesla to scale their production. It already has a lot of leverage in its capital structure. Ultimately, the way to think about this is we own Hyundai Motors. Hyundai Motors makes 9 million cars. Its market cap is smaller than Tesla's. Hyundai makes more electric vehicles than Tesla. Now, it's exciting, and all credit to what Tesla has achieved. All credit. Generally, we like going for the little guy. The problem is the valuation of the little guy has become irrational. So we think it's an interesting short with lots of stress points starting to emerge as they find out how difficult it is for a small car company to become a large car company. Finally, on currency, This is a opportunity to hedge away from neutral, which is just the currency of our underlying stocks. We have generally seen the renminbi as an expensive exposure. We're less worried about the Chinese economy, so we're not currently hedging renminbi. But we have a small hedge out of US dollars, and we're going long the Norwegian krona. So why the krona? Well, as Jon Snow would say, winter is coming, but as you know, at this time of year, it's actually quite warm in Norway. The economy is heating up, right? The super low valuation on the currency is a reflection primarily of very loose monetary policy. So we think the Norway central bank will have to tighten, and that will break the correlation to oil. Because it is correlated to oil, though, we bucket our krona exposure in with our energy stock exposure, and we set limits around correlated sources of alpha. So in summary, we think investors are generally overpaying for duration. But importantly, whilst you've got low valuation dispersion in the local stock market, you actually have very high valuation dispersion in the global stock market, across sectors and within sectors. Right? And energy is a great example of that. How cheap is INPEX relative to the US shale plays? So there's multiple dispersion. Don't mistake low price or low vol for low valuation dispersion. Valuation dispersion is high. Active management should actually work. We've got our three levers: our longs, our shorts, and our currency management. Thanks very much.